Very good evening, students. Students, we'll start on this particular part on the trust taxation first. Karthik, Ashwara, good evening to all of you students. Now, as far as the trust taxation is concerned, Mary, we have seen in this context, students, if you can recall, in the last May 23 attempt, the ICI students have targeted a theoretical question. So in all probability, students, I strongly feel that they should be targeting this time the practical ones. Piyush, one of the important aspects, students, of the trust taxation is this, that ICI has the ability, students, to really get into the amendments part of the chapter. This is what has been seen in the last attempt. Ramkumar, Piyush. So what I'm going to do, students, is that I'm going to deal with the amendments as well. Plus, if you recall, one RTP question we have done with that. I will also quickly recap that particular question with all of you. Chances are very high that that question may turn up in the examination as well. So let's get started with this. Now, students, first and foremost, because of the probability of the trust taxation, the total income question is very, very high. Now, in this case, how do we compute the total income of a charitable or religious trust? So that is one of the major challenge of the students that they do have about the computation of the total income of the trust. So we will quickly recap this particular part of it. So in this context, students, the format is there in front of me, and in fact, if you want to also scribble out something, you can just deal with that. Three particular columns would be made: particulars, amount and amount. So three columns primarily is what you are going to make. Students, the first and the foremost part that you can see in the screen is the income which is derived from the property held under the trust. The income which is derived from the property which is held under the trust. Now, income generally means, students, the gross receipt minus the expenditure. What is the income, students? As you can see over here, income is nothing but gross receipt minus the expenditure. All of us are aware of that point. But sometimes what happens is that the operational expenditure, ICI have the ability to put this operational expenditure below 15%. I think I have already told you when to do this and when not to do this. I will recall with all of you that 15% angle in this case, that is the operational expenditure that they've given to us in the question. Should I be reducing it from the gross receipt, or should I be taking after that 15%, whatever is the amount left, and from that amount I should reduce this operational expenditure? That particular point, students, is very confusing, because you find some of the attempts they ask, they have solved it by reducing the expenditure from the gross receipt, and they have net off as the income derived from the property held under the trust. But in some other attempt, you will find they have considered the operational expenditure as an expenses. Operational expenditure as the expenses, which is an application of an income. So in some of the attempt, it is considered as an application of the income, and in some of the attempt, they reduce that operational expenditure from the gross receipt so as to determine the income which is derived from the property which is held under the trust. So we will focus on this particular part very carefully, but for the time being, let's move further. I will come to that particular part a bit later. So students, income which is derived from the property held in the trust. What is the next particular point, students? The next particular point is about the voluntary contribution. In this case, that you can see for yourself. Voluntary contribution. Now, voluntary contribution should be other than the corpus. So corpus donation will not be included. However, there is an amendment in the Finance Act 2022 where the corpus will be included if you don't satisfy the following condition. That is, the corpus donation will be a part of the voluntary contribution, which means it will be a part of your income if the following conditions are not satisfied. Which are those conditions, students? In this case, now if you see primarily, students, over here, two Finance Acts are there wherein the amendment has been specified. We will discuss those two Finance Act amendments. First, the Finance Act 2021. Point number one, students, for the Finance Act 2021, just focus on the blue color right now. For the exclusion of the corpus donation, it should be invested in the mode specified under section 11.5. So 11.5 mode, which is about the government securities or deposit in the nationalized bank or the cooperative bank, as the case may be. If you are investing in that mode, which is nothing but the deposit in the government securities or the deposit in the nationalized bank or the cooperative bank, then in that case that is allowed. So for the exclusion of the C and D, point number 1, the corpus donation, it should be invested in the mode specified under 11.5. And if you see point number 2, any amount expended from the corpus cannot be considered as an application of income. So once it is treated as a corpus, students, now you tell me, from the corpus amount, if I am making an application, can that be considered as an eligible application for the purpose of exemption? Answer is no. So once the amount which has been donated as a corpus donation and it has been deposited in the mode specified under 11.5, then it is a corpus donation. Once it is a corpus donation, any particular amount which is expended from the corpus donation cannot be considered as an application. Any amount, if it has been applied from the corpus donation, cannot be considered as an application. Is that particular point clear to all of you? But take a reverse case, which is also a possible question in your examination, and the reverse case is this, that supposingly the corpus donation, students, has not been invested in the mode specified under 11.5. If it is not invested in the mode specified under 11.5, then will this corpus, will it be considered as an income? Will this corpus, will it be considered as an income? And the answer is yes, it will be considered as an income. And once it is considered as an income, then whether any amount which is expended from that income, can that be considered as an application? Yes, now it will be considered as an application. So therefore, students, I hope that all of you are now clear on this particular part. Coming on the point number 3 of blue, only focus right now, Finance Act 2021. Yes, Prem. If the amount is deposited back, then it shall be considered as an application in this case. So what does it imply? It implies that, just take an example, student. This is one thing, a question or an adjustment that they can give it to you. Adjustment would be that I have received a corpus donation. That corpus donation has been invested in the mode specified in 11.5, so it is a corpus donation. Okay, now supposingly, students, subsequently, if any application happens from that corpus donation, now what did I told you? Will it be considered as an application? Answer is no. It will not be considered as an application in this case, because it is already treated now as a corpus donation. So on a subsequent application of the amount from the corpus, that will not be considered as an application for the purpose of exemption. Okay, so that will not be considered as an application for the purpose of exemption. So fine, I had 100 rupees corpus. From that I have put up 15 rupees, 20 rupees as towards charitable or religious purpose in India. That will not be considered as an application. Okay, but tomorrow, once I get back my money from another source, what I am doing is that now that income I am again redepositing in the corpus to make it as 100. Once I get some more income, then I am redepositing that particular amount and I am redepositing to make the corpus as 100. Now that 20 rupees now, which I have redeposited, now can that be considered as an application? Answer is yes. Why? Because originally I may not have the income, so I may have used my corpus for the purpose of making a charitable religious purpose in India. But subsequently, but obviously that is not an application. At that point of time, it is not an application. But subsequently, when I have got an income from the property derived from the trust, from that income, if I am doing a redeposit, yes, students, it will be considered as what? As a eligible application. So that is the amendment of the Finance Act 2021. Now coming to the Finance Act 2022, this is again an important amendment, students, which has been there. What they are saying, that whether from the question therefore is, sometimes you are getting the contribution for renovation, sometimes you are getting the the contribution for renovation and the repair of the temple. Okay, renovation or repair of the temple. So can that be, that contribution which I am receiving for renovation or repair of my temple, can that be considered as a corpus donation, which means I will not be considering that as an income. So for that, the condition has been given to you, and the condition is that in this case, The first one, students, in this case is that once it has been given to you for repair purpose, obviously goes without saying that you will have to deposit in the mode specified in 11.5. Okay, and thereafter, once you want to use that money, you will have to use that money only for repairs and renovation. You will have to use that money only for repairs and renovation, students. That is point number one. Point number two, if you see, such corpus cannot be donated to any other person. So donation option is ruled out completely. Yeah? You cannot donate it and consider that corpus, contribution which was received for repair and renovation. Now if I donate that particular amount, then please understand this will not be considered as your corpus. It will be considered as your income, and once it is an income, accordingly the normal statement will be applied. Till the time you do the repair, friends, till the time you do the repair and renovation of your temples or the building, till that point of time, it would be invested, it should be invested in the mode specified under section 11.5. So this is all about the amendments related to the corpus part. Okay, so first and foremost point is that whether a corpus donation, students, will it be considered as an income? No, but provided the following conditions are satisfied. Most important condition is that it should be deposited in the mode specified under section 11.5. Now in this particular case, students, a question can come in the examination. They will only give you in the statement, voluntary contribution is say 100 lakhs, out of which 20 lakhs has been received as a corpus donation. That is it. They don't give you anything else. So please treat in your answer this as a corpus donation, but do write a note. And what is the note? The amount received as a corpus donation will be considered as such, provided the trust has deposited this 20 lakhs in the mode specified under section 11.5. So that will be put up in your note side. So chances are very high they will only give you voluntary contribution is 100 lakhs, out of which 20 lakhs is for corpus. So therefore just treat that corpus as a corpus only, but please back up with a note, which is very important. You don't write the note, your marks will be deducted in this case. So just keep that particular point in mind. Now other income of the trust, students, what are the other income of the trust? Government grant or the subsidy. Now please understand one thing, government grant and the subsidy is not considered as a donation because they are meant for some specific purpose. So please don't treat them as a donation at all. So government grant and subsidy, is it an income? However, is it an income? And the answer is yes. Government grant and subsidy are very much the income of the trust. That is point number 3. Now comes the next income, which is the capital gains income. Now students, capital gains income, first and foremost point is like this. Be careful over here in this context. So capital gains, students, which has been there in this regard. This is some of the example which I have put across for all of you, because please understand, I am putting this before applying that 15%. So yet 15% is going to come, but it will be coming very below. So right now 15% I'm not have yet applied on this. So therefore just please understand all the points which we have discussed up till now, point number 1 to point number 4, whatever we have discussed up till now, they are all before 15%. Okay, so now capital gains. Now how about doing about capital gains? Take a simple example. Example is, supposingly a trust has sold its capital asset. It is sold for rupees 20.5 lakhs. Expenses on transfer of the same is rupees 50,000. Cost of acquisition, students, is 15 lakhs, or if it is a long-term capital asset, then index cost of acquisition, and therefore you have your capital gain as rupees 5 lakhs. You have your capital gain, students, of how much? Rupees 5 lakhs. Okay, so this is what you are going to show it. This is what, students, you are going to show it. And now comes the major one, students, which is about the anonymous donation. Now so far as the anonymous donation is concerned, students, in this case, as you all are aware, anonymous donation, when we talk about AD, so far as AD is concerned, students, always bear this particular point in mind. A portion of anonymous donation is considered as a normal income. A portion of the anonymous donation is considered as a normal income. So what is the portion of the anonymous donation which is considered as a normal income? It is 5% of the total donation, or rupees 1 lakh, whichever is higher. Or rupees 1 lakh, whichever is higher. This much of the portion of the anonymous donation is considered as what? As the normal income. So now in that case, the question is, what is there in the total donation, students? In the TD, students, be careful. You have the voluntary contribution including corpus. So donation in this case. So while calculating this normal income, students, voluntary contribution including the corpus, that is there. Apart from this, students, the anonymous donation itself, thereafter, students, what about the government grant, students? Will the government grant be considered in total donation? Answer is no. Only the anonymous donation and the voluntary contribution, including the corpus, that is what will be forming a part of your total donations. So total donation will be the anonymous donation plus the voluntary contribution, including the corpus. But don't make the mistake of considering the government grant as a part of your total donation. This is not a part of the total donation. So this much portion, students, whatever it is, in this case, this will be considered as a normal income, and not an anonymous donation which is taxable at a rate of 30%. So this is your normal income, which will be placed before 15%, So therefore, this is the portion of your normal anonymous donation, which is your normal income, and that is what you have to consider it while calculating the total donation. These amounts should not be considered at first place. So anonymous donation, students, in this case, you will say voluntary contribution, corpus, and the anonymous donation entirely. Now once you get that amount, now you will take a subtotal. Students, and of this subtotal you will provide a 15% ad hoc exemption. A 15% of the ad hoc exemption will be applied on this subtotal. So subtotal is comprising of 0.125. What is that 0.125? Again, income derived from the property held under the trust. What is the next particular point, students? The voluntary contribution excluding the corpus donation, and for exclusion of corpus donation there are some conditions to be satisfied. Government grants and the subsidy. Thereafter the capital gains computed normally. Then finally, students, you have the anonymous donation, which is the portion of the anonymous donation which is considered as a normal income. So what is that portion? We have seen in the slide which I have just now have taken you through in this regard. After that, students, you will take a subtotal of it, and on that subtotal you will apply 15% ad hoc exemption under section 11. So that is primarily the ad hoc exemption, you get it, and after that you get the balance 85%. You get what, students? The balance 85%. Now comes the exemption, students, on application of income or deemed application of income in India. Application towards charitable or religious purpose in India. Now on the application part, students, there are many items which are there. So what we have discussed, students, is that two particular aspect. What are these two particular aspect? What is the eligible application and what is the ineligible application? Eligible application versus ineligible application, that is what we have made a distinction. So let's see the eligible application, but side by side just also see the ineligible as well. First point, students, is about the capital expenditure. Eligible capital expenditure, if supposedly you have acquired an asset, will that be considered as an eligible application? To that the answer is yes, it will be considered as an eligible application. But once you have considered a purchase or the acquisition of an asset as an eligible application, a corresponding depreciation on that particular asset will not be considered as for the purpose of deduction. The corresponding depreciation amount, students, will not be considered, students. That particular part will not be considered as depreciation. Prem, I'll just look upon the specified income taxation, we'll consider it separately. So therefore, just keep that point in mind. Now, second amendment is an important one, students. This is an amendment point which says that what is to be seen now is the actual payment. Students, what is to be seen right now is the actual payment is what will be considered as an application. Now, in the question, be careful. Supposingly, they say to you like this, just pay attention to what I'm saying right now to all of you, because that is also one of the adjustment which I've seen. Supposingly, they give you in the question that the trust has set apart rupees 5 lakhs for some purpose, okay, and it has expended that 5 lakh rupees in next year. Trust has set apart rupees 5 lakh for a particular amount, for a particular expenditure, and it has paid that expenditure in the next year. So what I told you just now, students, actual payment is what is only going to be considered. Just to earmark a fund for a particular expenditure and later on disbursing that amount, that will not qualify for the purpose of application. Now, one question that many will ask you at this stage is this: that's a set apart is accumulation, and accumulation is an eligible application. Agreed. But please understand that accumulate, you have to get this particular wording in the question, students. Please be careful. The wording in the question should be: the trust has exercised the option to accumulate the amount, or the trust has set apart an amount by exercising the option. The option word is very critical. If they plainly say this, that the trust has set apart an amount for incurring an expenditure which has been paid in the next year, that much of the statement, so you will say that it will not be considered as an eligible application. You will write in the note, what is that point you will write in the note? That since the trust has only set apart an amount for incurring this expenditure without exercising the option to accumulate, because that option, once you exercise, there are a lot of procedure that has to be considered, like for example filing of the return, intimating to this filing of the form number 10, intimating to the assessing officer as to the purpose for which you want to set apart, so on and so forth. So therefore that word option to exercise, to accumulate or to set apart, the option word is very important over here. So if the word option is missing, if they say only that the trust has set apart an amount for incurring an expenditure which has been paid in the next year, so you will simply say that this statement is based on the recent amendment which says that only the actual payment in the current year will be considered. Simply setting apart for the purpose of an expenditure which is paid later on without exercising the option of accumulation will not be considered as an eligible application. So that is what it is, students. Now apart from that, students, just consider this. Now this, please come to the ineligible part. Now come to the ineligible part after this. So ineligible, I've said application out of loan. This is an amendment, students, right? See the ineligible side, application out of loan. So if the loan has been taken and from that loan you have made an application, will that application, will it be considered eligible for exemption? No, you will not be eligible for an exemption. But if subsequently you do a repayment of the loan, whether that repayment of that loan, see on the left hand side now, whether that repayment of the loan, will that be considered as an eligible application? And the answer is yes. So please read the question very carefully. If they only say that the trust has made an application out of the loan, if that is a wording, then you will simply say that it is not an eligible application. But if they say to you that the trust has repaid the loan which was earlier taken for some charitable or religious purpose, then that repayment part will be considered as an eligible application. The repayment part, students, will be considered as an eligible application. Now students, in this case, see the donation part. Now in this situation, students, if the trust, if it has got an income in the current year, the trust, students, has got an income in the current year, and in the current year itself it is exercising the option, be careful, huh? In the current year itself it is donating this income to another registered trust. So that donation in the current year out of the income will be considered as an eligible application, provided when you give the donation should not be towards the corpus of that particular recipient trust. When you give the donation should not be towards the corpus of the recipient trust. If that is the case, then the donation which you have made will be considered as an eligible application. Is that point clear to all of you, students? Fine. So this is one thing that you have to be very careful about it. But just see on the right hand side now, students, over here, what is that? If supposingly, students, I have taken the option of accumulation. Supposingly, I have taken the option of accumulation. So once I take the option of accumulation, students, now you tell me, subsequently, can I donate the amount from the income which has been accumulated for a specified purpose? Subsequently, can I donate the amount from the income which I have accumulated for the specified purpose? To that the answer is no. So if you see on the right hand side, once the option of accumulation is taken, then the option of donation from the money so accumulated is not available at all. So that is the point which has been there, students. Now one more particular point, students, in the blue below this, can you see that? Just on the ineligible side in the blue. And what is that, students? On the ineligible side, excess of the application of the earlier year. So they can give you one data which tells you that of the earlier year there was there was some excess application that was being made which could not be adjusted in the earlier year. Why it could not be adjusted? Because in the earlier year the income was not sufficient. So in that situation, can in the current year you can do the adjustment or the set off? Again, recent amendment, the answer is no. Excess application of the amount in the earlier year will not make you eligible to claim a set off in the current year. Will not make you eligible for set off in the current year. Just keep that particular point in mind. Now friends, this is about the application. Now then we go to the deemed application. Now what is the deemed application, students? Over here, in this case, option of accumulation, students, there are two amendments which has been there. Two amendments which are being there. Once you exercise the option of accumulation, that option of accumulation could be considered as a deemed application. Two amendments are there, A1 and A2. Let's see first the A1 part. The money once accumulated, left hand side, money once accumulated for a particular object shall be applied only for that object. Obviously. So in that case, if you have accumulated for, say, a cancer or building a cancer hospital, then subsequently you cannot divert from that object. Say now you want to make another hospital for some other particular disease, that is not allowed. So once you have accumulated for a particular, you have to actually amend your objective. For that also you need to make an application of amendment. So that is a procedural part. But in the question they will only give it to you that the trust has exercised the option to accumulate for a particular purpose, and the moment you see another statement which says that there is a deviation of the purpose for which it was being accumulated, then that deviation, students, will not be considered as an eligible application. So on the left hand side, the money once accumulated for a particular object shall be applied only for that object. If there is any violation, then it shall be considered as a deemed income of the year of violation. Then it will be considered as what? As a deemed income of the year of violation. So that is the first amendment. Second amendment, students, is a very important one. And this is about, see, once I take the option of accumulation, students. So generally I have to specify the number of years for which I need to intend to take up the option of accumulation. The maximum year of accumulation is 5 years. But yes, can you reduce the year for which the accumulation you want to do? Yes, you can do it. No hard and fast rule. But the maximum is 5 years, students. Always keep that point in mind. The maximum year for which you can do the application is 5 years. Now when you count 5 years, students, the current year also now needs to be considered. Be careful, students. The current year also has to be considered as the year of accumulation. So current year and the next 4 years. Okay, current year and then the next 4 years. So 5 years in all. Now in this 5 years, you need to make the application towards the purpose for which you have done the accumulation. In these 5 years, you have to make the application for the purpose for which you have done the accumulation. If there is any failure or if there is any deviation in this case, then it will be considered as deemed income of the year of default or the 5th year, as the case may be. Deemed income of the year of default or the 5th year. 5th year would be, as I told you, students, in this case, previous year, current previous year 22-23, first year, that will also be considered. Second, third, fourth and fifth. So fifth year is previous year 26-27. But if supposingly you may have done the default earlier, you will go with the earlier years. But if you have not done the default in the earlier year and 5 years is also lapsed, then it will be considered as the deemed income of the 5th year. The deemed income of the 5th year, students. And that is precisely what it is to be considered. So now this is what it is in this regard. Now come to the next one, friends, the next part of the third one, exemption under 11(1)(a). This is the exemption of the capital gains part. Exemption under section 11(1)(a). This is the exemption under section 11(1)(a) part. Now in this particular 11(1)(a) exemption, it works a bit differently. How the exemption goes in for it. So supposedly in our example before, Before, in our example, before 15%, how much was the capital gains? In our example, how much was the capital gains? 5 lakhs. The capital gains which was there was 5 lakhs, which we have already discussed. So now let's have a look. For 5 lakhs was a capital gains in this context. Now see below this one. In our example, 5 lakhs was the capital gains which was there before 15%. Now see the item before this. Net sale consideration reinvested in the new asset of the trust. Please be careful, students. Net sale consideration reinvested in new asset of the trust. The amount reinvested, students. The amount reinvested is how much? Point number 1, 20 lakhs. What is 20 lakhs? 20 lakhs is the net sale consideration, full net sale consideration. Because if you remember the question, it was 20.5 lakhs. From this 20.5 lakhs, 50,000 was being reduced. And then the net sale consideration became as 20 lakhs. So 20 lakhs full it was reinvested. That is case study number 1. Case study 2 is there is a shortfall of reinvestment of the net sale consideration. And how much is the shortfall? 2 lakhs. So 18 lakhs only has been reinvested. 18 lakhs only has been reinvested. That is a shortfall. And in the third case, there is an excess over and above the net sale consideration which has been reinvested in the new asset. Excess over and above the net sale consideration which has been reinvested in the new asset. How much is that? 23 lakhs. Now on this 20 lakhs amount, students, reinvestment of the entire net sale consideration. So therefore the exemption under 11(1)(a) would be how much? 5 lakhs. Full exemption would be allowed. So if you are reinvesting the entire amount, students, if you are reinvesting the entire net sale consideration, so whatever was the capital gain of 5 lakhs, in my example, the full capital gain of 5 lakhs will be eligible for exemption under 11(1)(a). But supposingly there is shortfall of reinvestment of the net sale consideration, which is point number 2, which is 18 lakh rupees. So therefore, how do you do that? So therefore, students, you have to calculate like this. Calculate the revised capital gains by taking the amount invested as the net sale consideration. So whatever was the capital gains that you have calculated earlier, in that case, how much was the, how did you calculate the capital gains? 20.5 lakhs full value of consideration minus expenses on transfer 50,000. So net sale consideration was 20 lakhs. Now this 20 lakhs will be substituted with what? With this 18 lakhs which you have reinvested. So therefore this 18 lakhs is what will be considered as a net sale consideration. And now what was the cost? Cost was 15 lakh. Cost was 15 lakhs. So now how much is your revised capital gains? Your revised capital gain is 3 lakhs. Now it is a 3 lakhs only which will be considered as exempt under 11(1)(a). It is 3 lakhs only that will be considered as exempt under 11(1)(a), and that exactly how it will be considered over here. I hope that all of you are clear with this one. Now the third case, which is the third case, where the amount which was reinvested in the new asset was in excess of the net sale consideration. And how much is the amount that was being reinvested? 23 lakhs. So one thing is for sure, under 11(1)(a), you will get a full exemption of rupees 5 lakhs. Under 11(1)(a), you will get a full exemption of rupees 5 lakhs, and thereafter, students, there is section 11(1) because there is an excess application towards this new asset. And how much is the excess application? 3 lakhs. Once you compare the amount reinvested and the net sale consideration, how much is the excess? 3 lakhs. So this excess application towards the new asset will be considered as exempt under section 11(1). Will be considered as what? Exempt under section 11(1). And that exactly is the point, students. So this is all about the case for exemption under section 11(1)(a). That is what it is. Now let's see the next part, the deemed application as per explanation number 2 to section 11. Deemed application as per the explanation number 2 to section 11. Now if you see this deemed application, students, which is that? Which are the cases which are being covered? 2 cases are being covered in explanation number 2 to section number 11. Which are those 2 cases? First case, if supposingly the trust is following a mercantile system of accounting. The trust is following, students, what? The mercantile system of an accounting, and the trust has not received the money at all during the previous year. The trust has not received the money at all during the previous year. So in the books there is an income, but it does not have the money in its hand for the purpose of the eligible application. It does not have the money in its hand for the purpose of the application. So therefore the concept of deemed application is introduced. So therefore what we are saying in this case, there will be a deemed application in the previous year. So in that particular previous year, whatever is the money which you have not received, that is deemed to have been applied for charitable religious purpose in India. Whatever is the money which you have not received in the current previous year, that will be deemed to have been applied for charitable religious purpose in India. So that is what will be reduced as a deemed application. But be careful, students, over here in this particular context. But the money once received, on the left hand side, but the money once received should be applied in the year of receipt. The money once received should be applied. When it should be applied? In the year of receipt or the year which follows the year of receipt. That is, 1 year grace period has been given to utilize that money which you have received. So 1 year grace period has been given to you to utilize it for charitable religious purpose in India. If after receiving the money there is a non-application, after receiving the money there is a non-application or a shortfall in the application, then it will be considered as what? As a deemed income. It will be considered as what, friends? As a deemed income in the year which? In the year following the year of receipt. In the year following the year of receipt. So therefore, obviously, because you are getting a grace period, na? 1 year grace period. So therefore, up to that year, that is the 1 year plus. If you could not make the application or there is a shortfall of the application, then that particular portion will be considered as a deemed income. That particular portion will be considered as what? Deemed income in the year which follows the year of receipt. In the year which follows the year of receipt, students. I hope that all of you are clear with this one now. Okay. Now the second case, students, of the deemed application as per explanation number 2 to section 11. Now, students, this you have to identify in the question very carefully. And what is that? That is, they may tell you that the trust has received the money in the current year. The trust has received the money in the current year, but when they have received the money? On the last day of the previous year. Now you tell me in this case, definitely on the last day of the previous year, if you have received the money, now you are on the gunpoint to make the application on that day itself. So obviously the trust cannot be put on the gunpoint. So that is the reason why the trust needs to make an application, that for this reason I cannot make the application in the current year itself. For this particular reason I cannot make the application in the current year itself. So what will be the position of law? The position of law would be, fine, in the current year consider this to be deemed application. Consider this to be a deemed application. But in the very next year you have to make the application. In the very next year you will have to make the application. And if again in the very next year, if there is no application or there is a shortfall of the application, then that particular amount will be considered as deemed income. That particular amount, students, will be considered as what? Deemed income. Deemed income of what, students? Of the next year. So deemed income of the next year. So that is what, students, you will reduce all these amount of application, deemed application, capital gains exemption, all that amount will be reduced. And once you have reduced that amount, you will take the subtotal. After reducing that amount, you will take a subtotal, and from that subtotal you will add what, students? The anonymous donation amount. You will add what, students? The anonymous donation amount. This is the net amount, students, that you are going to add. Now what is this net amount? Remember, before 15%, a portion of anonymous donation was already considered as a normal income. Before 15%, a portion of anonymous donation was already considered as the normal income. So balance, whatever is left in the anonymous donation after that normal income, the balance amount will be added over here. So you will add it separately over here, and after adding it separately over here, now you will get what, students? Your total income. After adding it separately over here, students, now you will get what? Your total income. This is the complete format of how to prepare the total income part. Now I come, students, one by one to the amendments part, and on the amendment, students, you would have seen in the RTP, we have discussed earlier also in the RTP video. I'll just quickly revise that particular question with all of you in the RTP video. A quick revision, students, I'll just do with you. November 23 attempt RTP question. Again, an expected question could be there as far as this point is concerned. So let's have a look, students, over here in this case. Now this is in respect of the specified income, students. This is in respect of the specified income under section 115. You all know, students, 115 BBI. Now specified income, students, under 115 BBI is taxed at the rate of 30%. Now what constitute the specified income under 115 BBI, this is a checklist. One is 11.3. What is this 11.3? That is, once you exercise the option of the accumulation and there is a default. What could be the default? On the option to exercise the accumulation, the default could be, first, you remember one condition, once you accumulate the amount, then that amount has to be invested in the mode specified under 11.5. Once you accumulate the amount, that amount so accumulated has to be invested in the mode specified under 11.5. So assuming that this has not been invested in the mode specified under 11.5, then this is a default. Second, non-utilization of the amount by the end of the 5th year. Non-utilization of the amount by the end of the 5th year, that is also a default. Misutilization of the amount. What is the case of misutilization? Say for example, deviation for the purpose other than the purpose for which it was accumulated. Deviation for the purpose other than the purpose for which it was being accumulated. Another example of misutilization is donation given to another trust from the money which was accumulated for a specified purpose. Donation given to another trust from the money which was being accumulated for specified purpose. Even that is a case of misutilization. So this accumulation defaults will be considered as a part of your specified income under 115 BBI. Apart from that, specified income would also be of 11.1b. Now just now we did discuss that explanation number 2 to section 11. Remember that money not received, that option, that is a deemed application. So once the money is received either in that year or in the next year, you have to utilize the amount. And if there is a non-utilization or a shortfall of utilization, then it is considered a deemed income. Deemed income of which year? The year following the year of receipt. Deemed income of the year following the year of receipt. Now that deemed income is under 11.1b. Okay, section you may not remember it. I have just created the compartments just for the better presentation, but just a compartment has been made in this regard. So this is this 11.1b deemed income. Money has not been received, and subsequently once it is received either in that year or in the next year, there is non-application or shortfall of application, then it is considered as deemed income under section 11.1b. Now the third category of specified income, students, is 13.1c. And what is this 13.1c, students? Over here in this case, application of income on the specified person. Application of income on whom? On the specified person. Now who are the specified person? Specified persons are 3 persons, students. You just remember 3 persons. First is a trustee, primarily are the specified person. Second is the relative of the trustees and the author of the trust. They are also the specified person. And the third one, students, as far as specified person is concerned, is the substantial contributors. Now who are the substantial contributor? Who have made the total contribution up to the end of the previous year of an amount which is in excess of rupees 50,000. Total contribution that they have made up to the end of the previous year should be of an amount which is in excess of 50,000. Then such person are considered as specified person. So if the income of the trust has been applied for the benefit of the specified person, which is trustee or the author, relative of the trustee or the author, or the substantial contributor, then the application on the specified person will be considered as deemed income, and will be considered as specified income, and therefore this specified income will again be taxed under 115 BBI. And the last one, students, is 13.1d. What is 13.1d, students? The last one, you all know, students, various example like 15% ad hoc exemption we have seen. So 15% ad hoc exemption, that 15% also you have to deposit in the mode specified under section 11.5. Apart from that, when you choose the option of accumulation also, you have to deposit in the mode specified under 11.5. Also, the corpus donation we have seen, the corpus donation also should be deposited in the mode specified under section 11.5. So if there is a default on that, then 13.1d, it will be considered as what? As a deemed income. Now these are the 4 categories of the specified income on which 115 BBI will apply, and there will be a flat rate of tax at 30%. Now students, this on corpus donation, you have to be very careful on 3 points which I have discussed already with all of you. Again, I'm recapping with all of you that particular point which we have discussed earlier. Students, if the corpus donation has been invested in the mode specified under section 11.5, if the corpus donation has been invested in the mode specified under section 11.5, then we all know it is not an income. We all know it is not an income, students, at first place. Point number 2, if you see, if not invested at all, now in this context, students, if not invested at all, so fine. If you have not, I told you already, if the corpus donation has not been invested at all, then what it will be considered, students? It will be considered as the income of the trust, normal income. It will be considered as what? As a normal income. That is also I have discussed with all of you. Now, if you consider point number 3 over here, and that is important, students, because this case study of the RTP was based on point number 3. And what was that? If invested other than in the mode specified under 11.5. So they have students invested, but where they have invested other than the mode specified under 11.5. What is the mode specified under 11.5? I gave you the 3 examples: government securities, deposit in the nationalized bank, or in the cooperative bank. These are the, or the PPF, like that you make the provident fund, there you make the investment. So these are the eligible investment. Other than this, like for private banks or say any other particular cases where the investments are made, then those cases, students, will be considered, students, as what? As a case of a specified income. The post office and all these are there. In this case, that I will say as good as what, students, in the case, in this context of what? Post office also would be considered as a part and parcel of the government securities. So specified income. Now this is what is considered as a default under 13(1)(d). For the corpus donation, we are talking about it. For the corpus donation, this is the default under 13(1)(d), which will be considered as a specified income. This is only for the corpus donation. Like for example, that 15% ad hoc exemption that we get, I told you already. What you have to do, you have to deposit in the mode specified under 11.5, and if there is any default on that, then automatically, students, it's a specified income. But the corpus donation, when it will translate into a specified income, when they have been invested, other than the mode specified under section 11.5, that time that corpus donation will be considered as not only an income but a specified income, because if you become a specified income, you know the consequence under 115 BBI. On that note, students, if you see this particular question that we have discussed, a very quick go through, because chances is very high that this question same may be repeated. So let's quickly run through the same. Compute the specified income taxable at 30% under 115 BBI in case of a registered charitable trust, EDU8, running an educational institution from the information given below pertaining to the previous year 22-23. The main object of the trust is education. So this question is dedicatedly only for this specified income of 115 BBI. Corpus donation received by the trust is 12,20,000. The same has been invested below. Deposit in the post office, the government securities, I will say in that way. So therefore, yes, it is eligible. Fixed deposit with SBI, nationalized bank, not an issue. Deposit with the cooperative bank and land development bank, 1,10,000. Cooperative bank, again not an issue. But the last one, NBFC, engage in retail car, this is a default. So 4,10,000 from this corpus, 4,10,000 from this corpus will be considered as what? As a specified income, students. Specified income. Second point, students, which has been there over here, income applied by the trust for the benefit of the following donors. Benefit of the following donors. So whether they are the specified person. So let's see, Valish, name of the donor is Valish, 24,000, Ritesh, 48,000, and Arjun, 96,000. So Arjun, 96,000 is a specified person, and because he is a specified person, students, therefore this 30,000 of the income of the trust which has been applied will be considered as a specified income under 115 BBI. So this 30,000 will be considered as a specified income. Third one, students, income applied by the trust for the benefit of Mr. Vaibhav Gupta, which is the trustee of the trust. Again, he is a specified person. So 25,200 will be considered, students, as a case of a specified person in this case, isn't it? So that is what it is, case of a specified person. Point number 4, income applied by the trust for the benefit of Shamlal, Mr. Manor Arora, Sridhar Agarwal being the employees of the trust. So employees of the trust are not a specified person, so nevertheless it will not be considered as a specified income. Point number 5, value of educational services made available by the trust through its educational institution to 2 children of Mr. Vaibhav Gupta. Now Vaibhav Gupta is a trustee. Now be careful, students, over here. This was point also been discussed with all of you. Yes, Aishwarya, even that would be. Apart from this, Aishwarya has asked, this was specifically for this 115 BBI. Students, one more point if you want to write, just write next to that for specified income. One more point, any income which has been applied outside India, any income, students, which has been applied outside India, will that also be considered as a specified income? Income which is applied outside India, will that also be considered as specified income? And the answer is yes, it will be. Income which is applied outside India, will that also be considered as specified income? And the answer is yes. Anyway, students, now coming on point number 5. Now point number 5, this point also was being discussed with all of you earlier. Value of educational services made available by the trust through its educational institution to 2 children. Now be careful, students, in this context. See, that much of the, if supposingly in the trust which is for education, if the benefit, not the income has been applied, but what has been given, the benefit of that particular trust has been extended to whom? To the relatives of the trustee. Benefit students of the trust, here it is educational trust, has been extended to the trustee or the relative of the trustee, then that benefit so extended, here the benefit is in the form of providing the education services to the children of Mr. Vaibhav Gupta, who is a trustee. Here it is a case of extending the educational services to the children of Mr. Vaibhav Gupta, who is a trustee. So that particular extension is not considered as a specified income. Be careful on that. Yes, only that much portion of the income is considered as that much portion which you have invested in the benefit of the trust. That much portion of the benefit that you have extended to whom? To the trustee or the relative of trustee. That portion only is considered as income, not a specified income. That portion only is considered as what? As an income, but not a specified income. So this is not going to be a part of your specified income, students. Just keep that particular point in mind. This will not be considered as a part of your specified income, students. So this is what this particular point number 5 is all about. So this is not a specified income in this situation. Point number 6, students, value of educational services made available by the trust through its educational institution to children of Mr. Manor Arora and Siddharth Agarwal. They are in any case only the employees, I suppose. So for the employees as such, they are not a trustee, neither they are relative of the trustee, and that is the reason why 115 BBI will not apply. And the last one, students, point number 7, which has been there in this particular context. Amount set apart in the previous year by the trust for charitable purpose under section 11.2 utilized in the previous year 22-23 for making donation to another charitable trust whose object is also education. Now once you take up the option of accumulation, in that case, do you have the option to make a donation in this case, students? Do you have the option to make the donation in this case? Answer is no. So will it be considered as a misutilization? Answer is yes. Again, will it be considered as a part of your specified income? Answer is yes. So students, in this situation, what will be the scenario? In this case, so 2,13,000 in this situation plus 25,200. That is the another amount, 25,200 in this particular case. So therefore point number 7, point number 3, and from here 30,000, and then 4,10,000, 4,10,000, and you add all this, students. I suppose it was, we have discussed this point as point number A, if I can recall in my memory, students, on this part. This is point number A, students, in this context. Quickly, students. Point number A, in this particular context, yes. So this is all the things has to be looked upon, students, as far as this particular point, 6,78,200. Perfect. So therefore, this is what it is, students. So just keep this particular point in mind, and this specified income will be taxed at 30%. Chances of this case study being put across directly in your examination is very high, students. So just be very careful on this particular part. Now, students, therefore, now in this context, in this situation, the other particular part of the trust taxation, apart from the full-fledged statement that we have revised about what is now coming, coming on this particular part, students, the income part. No, Prem, it's one and the same thing. The option of set apart or the option of accumulation. When you have the set apart and the accumulation, in this case, in both the cases, the donation option is not available to you. In both the cases, the donation option is not available to you. Okay. I told you one point, again I'm repeating this point, don't get confused, students. If in the statement you find this in the question, that the trust has set apart an amount for an expenditure which has been paid in the next year. If this is a statement which they are giving it to you, then please write, in this case, make an assumption in this case that they have not exercised the option of accumulation. They have not exercised the option of accumulation. What is the statement you should be getting in the question? The trust has set apart for an expenditure which has been paid in the next year. If this is what they are getting it, then straight away write that we are assuming that the trust has not taken up the option of accumulation. Okay. All the other cases, when they tell you about accumulation and the set apart, that is inherently implied that the option has been exercised. They will write this option. But supposingly, like in this case study which we are referring, in that the word option was missing in this case study also. But just see the channel. What is the channel in this case? Ideally, the option what should be there, because that is what you have to do. Without the option being exercised, the AO will never come to know about it. But just see what was that particular sentence. Sentence was about that having set apart, you are donating the amount in the next year. Therefore, they are inherently implying upon on what? Implying upon on the fact that they have exercised the option and after that they are donating it. So therefore, if once you have exercised the option and after that you are donating it, what did I told you, students? It will be considered as a misutilization and accordingly a specified income. And therefore, in this situation, students, once it is a specified income, in this case, what I am going to say? Indeed, once it is a specified income, students, it will be taxed under 115 BVI. Now, please come to this particular part again. Money. No, not money, Chandni. Facilities being extended. What I told you, that the facilities which you have extended to whom? To the trustee or the relative of this trustee. So that facility per se, only that much portion of the facility is what has to be taxed. Okay, that much value of the facility has to be taxed, but not taxed as a specified income. But not to be taxed as what? As a specified income is what I told you in this case. So whatever is the facilities which has been given to the trustee or the relative of the trustee, that portion or the value of that facility is what has to be taxed, but not as a specified income. Now coming on this particular part, students. In this case, yes, that value, Prem, that value has to be taxed. Value. Coming on this part, students, this is where the maximum confusion, students, is there so far as the income is concerned. Should I go and reduce the operating expenditure from the gross receipt, or should I consider the operating expenditure as the part of the application? What should be my treatment? Should I consider the operating expenditure as an application, or should I be reducing the operating expenditure from the gross receipt? What should be my treatment? So the treatment is like this, students. Just check whether on that operating expenditure do we have, be careful, huh? Just check that any information that they've given to you, any information that they've given to you where on the operating expenditure, like salary to teachers, for examples. Okay, so therefore on any operating expenditure, is there any default of what, students? This 40A3, which is payment made in cash, or 40AI TDS default has happened. If there is any default that has happened on any operational expenditure, I'm using the word any operational expenditure, then the entire operational expenditure, so there may be 2 or 3 items of operational expenditure, and on one of the item of the operational expenditure there is a default which has been of 40A3 or 40IA. If that is the case, then whatever are the 2-3 operational expenditure which has been given to you, entire you will consider it after 15%, which means that you will show this as gross receipt. You will show this as gross receipt in this case. So the entire operational expenditure you will take it below 15% as an application, but obviously application would be only 30. The 30% would be disallowed, applying 40IA, and the balance would be considered as eligible application. And if the entire amount is paid in cash, then in that case 40A3 fully that will be disallowed. There will not be any application, and that is what you have to take a position. That is what you have to take a position. But I will tell you, student, now this is the position on your main answer. This is the position in your main answer. Again, I'm repeating this out, friends. Just pay attention to this. If on any operating expenditure they have given you a default that has happened of either 40A3 or 40AIA, then the entire list of operating expenditure, you will take this as below 15%. You will consider it below 15%, and accordingly you will put across the amount. So if it is 40IA default, then the entire operational expenditure which has been there, you will consider below below 15%. Same way, if there is a default of 40A3, in this case the gross receipt will not be reduced with that particular with the any operational expenditure. Simply put, you will take the operational expenditure below 15%. I hope that this particular point is clear to all of you. Now my only submission to all of you is this. I told you what is the main solution. I told you, students, what is the main solution, but you will give a note about the alternate solution only as a form of a note. And what is a note? Note will be that how alternatively, like for example, you are reducing the operational expenditure from the gross receipt because there was no default on any operational expenditure, the default of 40IA or 40A3. So what you will write a note that you in your main solution you have already reduced from the gross receipt the operational expenditure, and the net income is what has been put up as your first statement. Net income is what you have put up. Then in the note you will put what is the note that you are going to put up? That alternatively the expenditure could be considered as what? As an application of income and could be reduced accordingly. And if you take the other approach, wherein on any operational expenditure there is a default and you took the entire operational expenditure after 15%, then a note could be considered that alternatively this could be considered in the part of your solution. This is a note which is must in this context. So this is a note which is must of the alternate solution, because although I'm telling you this approach, but ICI in their solution somehow they have even dodged on this, but 80% whatever I have told you, they have gone with that direction, but 20% they have went haywire. So therefore, please do ensure to make this particular alternate solution note in this regard. I hope that all of you are clear with this one. With this, students, fully the computation is over. We have discussed this particular computational part of the entire total income. Now I will take across to the other aspect of the trust taxation. On the other aspect of the trust taxation, now even the anonymous donation after 15% means we have to deduct a disallowance expenditure in operating expenditure. After 15%, I said that check out now if it is a 40IA disallowance which is applied, then only 70% would be allowed as an application. and if it is a 40A3 default that has happened on the operational expenditure, then that operational expenditure cannot be allowed at all, because cash default in this case has happened in this case, isn't it? Now coming on to the next particular part, students, over here in this context on the trust taxation. Students, on the trust taxation, quickly in this regard, students. Specified income. Now students, now be careful. One more specified income, students. So if I just pull up the list of specified income, so apart from this, students, this is a specified income. 4 lists are there. 4 items of specified income we've discussed. 1 item we added further of specified income. 5th item of what? Application outside India. This is the 5th item of specified income. Application out of India. This is the 5th item. And 1 more item, students, is there. And what is that item? Once you choose the option of accumulation, students, be careful on this particular part. Once you choose the option of accumulation, then you cannot have your balance income. No balance income. Balance income will be specified income. Specified income where the option of accumulation is exercised. Where the option of accumulation is exercised. So balance income will be a specified income. Now what it is, once you choose the option of accumulation, and after that also there is a balance income finally which is left out, then that balance income which is left out, that will be considered as a specified income, and on that the tax of 115 BBI will be made applicable in this case. The tax of 115 BBI will be made applicable in this case. So balance income will be a specified income where the option of accumulation is exercised. There is a very small question, students, which has been there. I'll just quickly run through that for all of you, so that at least that has been taken care of in this context. So students, if you see over here in this regard, see here, so income derived from the property held in the trust is 100 lakhs. Income derived from the property held in the trust is 100 lakhs. Application of income in India is 50 lakhs. Application of income outside India is 10 lakhs. Accumulation of income is 22 lakhs. Now, in this case, students, so 100 lakhs is the income derived from the property held under the trust. Application of income in India 50 lakhs. Application of income outside India 10 lakhs. And accumulation of income is 22 lakhs. Now, in this case, any case, we know 10 lakhs is a specified income, which we already know because it is applied outside India. Let's see the statement, students, how the statement looks like. Income derived from the property 100 lakhs. Ad hoc exemption 15 lakhs, 15%. Balance is 85. Now exemption on application. Exemption on application, students. In India, how much is that? 50 lakhs. 50 lakhs. Exemption under 11 on accumulation 22 lakhs. So exemption on accumulation is 22 lakhs. Now exemption on application outside India, in this case, students, it is nil. Okay, why? No exemption is available. And now tell me, what is the balance? Balance is 13 lakhs. So balance is 13 lakhs. Now this 13 lakhs, you can say, sir, this consists of 10 lakhs of application which I have made outside India. This 13 lakhs consists of what? 10 lakhs which I have made, which I have applied outside India, and 3 lakhs which is the balance amount. So this 10 lakhs of application outside India is specified income, and the 3 lakhs which is the balance final amount which is left out is also a specified income. So total specified income would be 13 lakhs. Total specified income, students, would be 13 lakhs, students. And that exactly is the point, students, that you should always keep in mind. I hope that you all are clear with this one, students. So entire would be this particular thing which will be there. So that is a point of the amendment. So I have now made the comprehensive chart for all of you, so that you all are aware, students, in this case. Now apart from that, students, in this computational part, we have considered everything of the adjustments part of it, and also what is required initial stage. Anonymous donation also we have considered it in this context. 11 money also has been considered, students, in this regard. Now directly, students, what we will be dealing with it will be 271 AAE penalty, students. You can skip for this attempt. This will not be targeted. Although we have discussed this particular part, but you can skip, students, this particular part of 271 AAE if you want. Now the next part, students, of the trust taxation, students, is on the taxation of the accredited income. Now again, this is a practical part which could be targeted in the examination, students. Always remember one thing in this case, students: taxation of accredited income. Exit tax, what we all say. Now exit tax. Now students, as you all know, in this case, there is a tax that will be charged on this one at 30% plus 12% plus 4%. So the tax that will be charged on the accredited income, what is the tax will be charged? 30% plus 12% plus 4% on the accredited income. Now that accredited income, students, how to compute it is what we are looking at this point of time. 30 plus 12 plus 4 is the tax rate to be applied on the accredited income. How to calculate the accredited income? Now please understand what are the defaults because of which the exit tax or taxation of accredited income comes into picture. What is the default? The default, students, is the conversion, students. Students, I have done the conversion of a trust in this situation. So there is a conversion of the trust in this regard, in this situation, students. So say conversion, students, is from public trust to private trust. That is one of the example. So now it will be exit tax will be applicable, or the merger. Now students, it is important. If supposedly, students, this trust is merged with another trust, and that another trust, although that another trust may be registered, be careful. Although the another trust may be registered, but it does not have the similar object. Although the another trust may be registered, but that trust may not have a similar object, then in that particular case, that merger that has taken place, that merger, students, that has taken place, that merger will be considered as a default and accordingly will be part of your accredited income in this regard. Will be a part of your accredited income, students, in this regard. And the third one, students, is what? The dissolution. If the trust is dissolved, that is it. Now only one thing, if the trust is dissolved, students, you can save yourself from one thing. Do you know what is a savior? Savior is that if the trust is dissolved, then what you should do is that you can transfer or donate the assets to other trust. So if you are transferring or donating the asset to another registered trust, then that will save you from the exit tax to the extent of the donation which is made. So donation, students, in two cases are considered eligible as an application. Two cases only. Which are the two cases? First is if you make the donation in the current year, normal, going concern. When the trust in the current year, if they are making a donation, then that donation is considered as an eligible application. And the second donation which is considered as an eligible application is at a time when the trust is dissolved. At that point of time, also the donation if you do of the trust property, then that also will be considered as the eligible application to the extent of the donation, and that is what will be reduced. That is, students, what will be reduced in this case. I hope that all of you are clear with this one in this regard. So this is what it is in this context. Now if you see in this regard, students, over here, once the default is there, then the trust will have to pay an exit tax at 30 plus 12 plus 4. That rate would be applied on the accredited income. What is accredited income, students? You can see over here accredited income is, can you see this one, students? Aggregate fair market value of the total asset minus the total liability is your accredited income. Aggregate fair market value of the Prem is asking that, sir, in the current year donation, if I am giving it to the same trust or a different trust, is it allowed? Answer is yes. Only factor is that trust in the current year, if you are making a donation, that trust should be a registered trust. That is the only criteria. Now accredited income, students, so please have a look over here. Aggregate fair market value of total asset minus the total liability is your accredited income. Now accredited income, students, from this accredited income, first of all, you have to calculate fair market value. The valuation part, I'm taking you to the next slide. But just before I go to the valuation part, this accredited income, students, will exclude what? Exclude Be careful students over here. Exclude that asset which the trust has acquired out of an agricultural income. Now please be careful. One thing which you should be always be careful about it. And what is that, students? The trust, which is the trust, if they are the public trust or the religious trust, if they are receiving an exempt income, then please understand one thing, that income is not exempt otherwise. The exemption will be applicable only if the trust has applied that income for charitable religious purpose in India. Only then the exemption will be given, which means that the exemption under section 11 will override the exemption under section 10. The exemption under section 11 will override the exemption under section 10 with only one exception, and that exception to this is 10(1). It is only the 10(1) exemption which operates independently, which means what? Which means that if supposingly there is an agricultural income, then that agricultural income is exempt outrightly under 10(1). There is no need of an application to be made for getting the exemption on the agricultural income in India. So therefore there is no condition of application of agricultural income in India to get the exemption. The exemption is unconditional under section 10(1). That is the point that you should always bear it in mind. Now therefore, supposingly students, if a trust has acquired any asset, out of what? Out of the agricultural income. So can I therefore say that there is no violation as far as the exemption of section 11 is concerned? Can I therefore say that there is no violation as far as the exemption of section 11 is concerned? Yes. So therefore no violation has happened as far as 11 is concerned, and because there is no violation of 11 that has happened, therefore on the accredited income, that value of the asset which you have acquired out of the agricultural income, from that accredited income you will remove that value of the asset. Asset. Apart from that, students, the next box. Now the trust, students, be careful. The trust may have been registered, say in 2018, but the asset may have been acquired before 2018 when it was not registered. If it is not registered, it means that on those years it has paid the tax. In those years, students, it has paid the tax. It has not claimed the exemption. So if the trust has acquired any asset which is still lying in the balance sheet as on the date of dissolution, merger or conversion as the case may be, those assets were acquired in that particular period when the trust was not eligible for the exemption. In that particular case, what we are going to say, we will remove that particular, the value of that asset. Why we will remove? Because that asset which was acquired did not got any exemption under section 11. That asset which was being acquired did not got any exemption under section 11, and therefore there is no misuse so far as the exemption of section 11 is concerned. So that value of the asset which is as on the date of conversion, date of merger, date of dissolution, if that asset is still lying, then that value of the asset also has to be removed. And the last point, students, which is there is about, I told you, any asset, if the trust, if they have given a donation to another trust, so that value also will be reduced in this case. This is what, students, is a case of the accredited income computation. And now we will try to decode how to calculate the fair market value of the asset as on that specified date. Which is the date? The date is the date of merger, date of dissolution, date of conversion. But before I do that particular point, students, please have a look to this note. In that note, point number 3. And what is this point number 3? The exit tax should be paid within 14 days from the specified date. Within 14 days from the specified date, the exit tax should have been paid. And now point number 4, it says interest for non-payment of tax within the prescribed time. And what is the interest, student, that will be charged? The interest that will be charged will be a simple interest of 1% per month or part thereof. It shall be applicable for the period which will start from the date immediately after the expiry of that 14 day. The date immediately after the expiry of the 14 date, from that day you will count, and it will end when which will be the ending date of count will be the date when the exit tax has been finally been paid. So that is what, students, you will keep in mind in this regard. Now with that particular part, students, we will now look upon to this valuation part of it, how the valuation is to be undertaken. Just try to see this balance sheet, students. Dispose assets given to same object or different object. कौन सी trust में are safe from exit tax? Same. If it is same, then no exit tax. If it is a different trust with a different object, although it may be registered, exit tax would be applicable. Coming on the balance sheet, students, let's see the valuation, how the valuation has to be done. So in this case, assets minus the outside liabilities. See the asset, what could be the possible angle of the asset, students. In this case, students, I have referred as just see. Always remember just see, because only for just see that there is a valuation that has to be done. Rest of it you have to take book value or you have to ignore it. Only for just see that the valuation has to be done. J is that jewelry, bullion, all those precious item, that is jewelry. A is the artistic work. So for J and A, students, for J and A, it will be, see the arrow which is going next to that, the fair market value amount as it will fetch if sold in the open market. That is for jewelry and the artistic work. For the immobile property, students, for the immobile property, in this case it will be higher of the amount as it will fetch if sold in the market. Immobile property, I'm talking about it, or the stamp duty value of this on the specified date. For the immobile property, this is what will be the valuation, the amount as it will fetch, just like the jewelry and the artistic work, but that will be compared with the stamp duty value on the specified date. You will take the higher of the two amount. Now security has got a special valuation, we'll discuss that below this, but before that, see the other value of the assets. Debtors, cash and bank, book value. If there is any tax, advance tax given to you on the asset side, please ignore that. I must say that taxes or provision for taxes primarily will be excluded in this regard. So taxes, students, will be excluded completely. Fictitious asset, students, again will be excluded. Other movable property like stock and trade, simple. Market value. What is market value? Amount as it will fetch in the open market. Other movable property, amount as it will fetch in the open market. Coming on this part, which is security. Now security, students, divided into two parts. What is that? Shares and the other security. Now if it is a listed shares, then if it is a listed share, students, then the listed share will be average of the lowest and the highest price on the recognized stock exchange on the specified date. Average of the lowest and the highest price on the recognized stock exchange on the specified date. That is for the listed shares. For the unlisted shares, students, for the unlisted shares, this is what it would be. A plus B minus L into PV divided by P. This PV means if a trust is holding an unlisted shares as its asset, then PV divided by P is nothing but the percentage of the holding of the trust in the shares of the unlisted company. So how much is the percentage of the holding of this public trust in that particular unlisted company? That is the PV divided by P. That is the percentage of holding. What is this? A plus B minus L. It is nothing but the net asset value. A plus B is the asset value minus L is the liability. What is A? Book value of all asset other than what? Other than just C. Book value of all asset other than just C. Just C, you will always do the valuation. Already you know how to do the valuation of just C. And for the remaining, so just C is your B. Just C, students, is your B. And what is your A? Book value of all the assets, all the remaining asset. So for the unlisted shares, its valuation that you will do would be A plus B minus L. A will be the other asset, B will be the JSE which is held by the unlisted company. The JSE which is held by the unlisted company, the valuation is same as we have discussed above. A would be the book value and L is the outside liability other than contingent liability and provision for income tax. I already told you taxes, whether it is on the asset side or whether it is on the liability side, the taxes, students, will always be ignored, will not be considered, neither for the asset nor for the liability. And also the contingent liability, students, also will be ignored. So that is what will be the scenario: A plus B minus L into percentage of the holding of the trust in that unlisted company, and that will give you the value of the unlisted shares. Any other security any other security, students, like debentures and all, then fair market value. Fair market value, students. So this is how the valuation, students, has to be done in this regard. In this case, one question, students, is there. Let's try to do this question quickly. In this case, students. Now this is a good question, students. Question number 9. There is one particular point, students, on this valuation part. And what is that? See, this is the beauty of this question, students, over here. The registration was granted under section 12AA of the Income Tax Act 1961 on 1st of April 2009. Students, in 6, if the registration is granted on 1st of April 2009, it means that the application would have been made earlier, before 1st April 2009. So if the registration has been granted on 1st April 2009, application would have been made in 2008, 2009. Tell me then whether the exemption under 11, will it be made applicable from 2009-10, which is the year in which the registration was granted, or it will be from 2008-9, the year in which the application was being made. Which will be the year in which the exemption under section 11 will begin? So the exemption, students, under section 11 will begin from the year in which the application was being made, and accordingly it will start from previous year 2008-2009. Okay, so that is how it should always be considered. Yes, Ashwara, Karthik, yeah, that is how it should be considered. So this was cancelled, students. The registration granted was cancelled on 31st Jan 2023 on the finding that the trust was merged with another entity having similar object. No, sorry, with another entity neither having similar object nor registered under 12AB. An appeal was being preferred against the order of cancellation, which was dismissed by the appellate authority. The order confirming the cancellation was received. The balance sheet of the charitable trust on 31st of Jan 2023 and its information is given below. Capital fund, sundry creditors. Students, as I told you, accredited income means the fair market value of the asset on the specified date minus the liability. The liability has to be the outside liability. What is the outside liability? Other than contingent liability and other than provision for taxation. That is what you should always keep in mind so far as the liability is concerned. Now, if you see about the assets, so you have in sundry creditors 335. Sundry creditors, students, is 335. After that, students, if you see the assets, land existing since 1st of April 2008, how much is that? 100 lakhs. The value of the land, students, is 100 lakhs. So will this be considered, students? Whether when this land was acquired on 1st of April 2008, whether the exemption was applicable for the year 8-9? Answer is yes. Just now we have discussed that point. So therefore the exemption was given, and because the exemption was given, accordingly this particular FMV of this asset will be a part of your accredited income. The FMV value of this asset will be a part of your accredited income. Now the next one, students, land and building purchase in the year 2015 is 800. Land and building purchase in the year 2015 is how much, students? 800. Okay, so that is the case. Any case, this is way beyond the registration date. Thereafter, students, 2000 equity shares of 1000 each in Messrs X Limited. Shares are listed in Bombay Stock Exchange at face value is 20. Balance in the current account of a nationalized bank is 10. balance in the FD with scheduled bank is 200, cash in hand students is 3.5, and TDS 1.5. You will ignore TDS. Total has been given to you. So now students, in this case you have to do the valuation of the 2 lands and 1 equity shares. For equity shares which are listed in Bombay Stock Exchange, you will only take what? The average of the highest and the lowest. Let's see. Stamp duty value of the land existing on 2008 as on 31st of Jan 2023 was rupees 120 lakhs. But if sold in the open market, the property would fetch rupees 250 lakhs as per the registered valuer certificate. So therefore, this is what it will be fetching is 250 lakhs as per the registered value certificate. Point number 2, land and building purchased in 2015. If sold in the open market, 1000 lakhs as per registered value certificate. Stamp duty value is 1050. So if you see in the both the cases, the stamp duty value students is higher. So we will go with the stamp duty value in this both the cases. We will go with the stamp duty value in both the cases. In first case it will be 250 lakhs. In second case it will be 1050 lakhs. Point number 3, the highest and the lowest value per share. So you will take the average on this. Now point number 4, included in Sunday creditors is rupees 30 lakhs provided on estimated basis to contractors for which no bills are received. So I think that will be reduced. Calculate the exit tax and state the latest date by which the said tax has to be paid. So specified date is 31st Jan 2023. That is the date when the merger has happened or the conversion has happened. And then from 31st Jan, next 14 days, you have to make the payment. Next 14 days, students, you will have to make the payment. That is what it is. Now, I think, students, we have already discussed this particular part. Just let's see the working note live in this case. So, in the liabilities, 335 was the liability. From 335, 30 was being reduced. From 335, 30 was being reduced because that was about the contingent liability. So, therefore, it becomes how much? 305. It has become 305. Now, as far as asset is concerned, 250, you will take 250 higher. Other was 1050, which was also the higher amount. This is the average. So, 2000 shares into the average price. Average price, students, is 1074.50. So, that is the case. Rest of the asset, TDS will be excluded. TDS, students, will be excluded. So, rest of the asset in this case, students, will be what, students, in this case? Rest of the asset, students, in this scenario will be what? Book value. It will be the book value, students, that will be considered. Okay, so that is how the things has to be considered, and that is what it is. So students, we are done with this particular part. I think one question should be sufficient in this case. Rest of it, it's the same thing again and again. That will be considered over here. So students, we are done with this particular part of the public trust, students. In this case, private trust, students. Now what I will suggest to all of you, if you want to refer one question of computation, you can refer it, but don't take a very comprehensive question because they will ask only for 8 marks. Now the time has gone when they used to ask a big question. So take a small question of computation and just immediately deal couple of questions, and that should be all. Couple of questions, students, and that should be all, students, in this case. Fine. So therefore, this is all about the public trust taxation, including the exit tax, including the amendments. I have already covered everything thoroughly in this scenario. Now, students, private discretionary trust. My suggestion is that those who have not done it, they can leave it. Those who have done it, I have also done it earlier, students. They can quickly refer this particular chart and refer quickly this question. And in fact, through that only, you can just jump into it. I'm not revising this part because I don't know whether you people would have done it or not for private discretionary trust. So I'm not right now going to take you across to this particular provision if you are doing it for the first time. Leave it, students. But it was targeted in one of the attempt in June 2021, I suppose. So you can just leave that thing across. Students, now therefore what you have to do now in the trust taxation, one question which could be a computation of total income question, you can do that. Amendments we have covered already, so that has already been taken care of. So only one question, you can just refer it one more time. And students, last is this. Please do this time political party exemption of 13A. I'm not doing this political party 13A, which is the most simple exemption which is there. Apart from PGBP income, they get full exemption in respect of all the other income, provided some condition has to be satisfied. Like they have to maintain the books and the donor's contribution who have given the donation in excess of an amount. So that one particular 13A political party, students, you do it this time, chances of political party, it would be a lollipop if it comes in the examination, and that is exactly what it would be in this regard. In this regard, students, I hope that all of you are clear with this one. Now with that, students, we will now switch over to the mat. So now just take a note what you have to do immediately after the lecture gets over. One particular question of computation of total income. Private trust, if you have done it, only then do it. If you have not done it, forget it. And the third one is 13A, political party exemption, students. You will have to do it because chances of that, if it comes, will be really be a bonus for all of you. Now coming to this particular topic on the MAT, the minimum alternate tax, students, in this scenario. So MAT, students, is again, if you all are aware in this context, one of the most important particular chapter which could be expected, students, for all of you in this regard. The MAT, students, will be one of the most important particular area of the question, students, that could be there to all of you in this regard. Now students, first and foremost, students, is about this index adjustment, which will focus on this index adjustment first, and I'll directly take you through the practical questions in this case. So let's first target the index adjustment in this regard. So far as the index adjustments are concerned, students, as you all know, in the case of index adjustments on the MAT, first I'll do index adjustment on the MAT, and then I will do the other remaining adjustment on the MAT. All the other remaining adjustment on the MAT, let's deal with that part. Now, as far as the index adjustment are concerned, students, as far as the index adjustment are concerned, you all are aware in this context. Students, you all are aware of this particular context on index adjustment. There are two statements. When the index has to be prepared, there are two statements. Other comprehensive income, which will be classified to the profit and loss account. So again, just recapping the MAT, just let's try to quickly do a recap of the MAT. You have the net profit as per the books, as per the Companies Act. On that net profit as per the Companies Act, you are doing specified add and specified less. On that net profit as per the book, students, you are doing specified add and specified less. All of you agree to this one? So this is a specified addition or specified deletion, students, that you all do it. Now in that that will give you the book profit. Now in that specified add and specified less, you have some index adjustment to be considered. Now when you have an index adjustment in the question, keep this point in mind. A company who is supposed to prepare the index statement, a company who is supposed to prepare an index statement, students, they have got two OCI, other comprehensive income. First OCI, students, first OCI is the OCI which will be classified into the profit and loss account. So first OCI is the OCI which will be classified in the profit and loss account. Now that OCI, please don't touch it, because that is classified in the profit and loss account. You are not supposed to touch it, because they will give you the items of the OCI which will be classified in the profit and loss account. You will not touch it. But the OCI which will not be reclassified in the profit and loss account, only for that you need to make the adjustments. Only for that you need to make the adjustment. Now what is the adjustment that you have to make? Now if you see over here, point number 1, items in the other comprehensive income in the statement of profit and loss account, under the head item that will not be reclassified to the profit and loss account. Okay, now on this item you will add amount credited to the OCI and amount debited to the OCI. So in that OCI which is not reclassified in the profit and loss account, so item which is credited to this OCI you will add, an item which is debited to this OCI, which OCI, which is not reclassified to the profit and loss account, so item which is debited to this OCI you will less in arriving at a book profit. However, in that add and less, you will not consider the following items. Which are those following items which will not be considered in those add and less? This is a list. So this is a list that we are supposed to concern ourselves with. And what is that? No add and less. of the items shall be made. No add and less of the item shall be made in respect of revaluation of the asset or gain or losses from investment in equity instrument designated at the fair value. Designated to at the fair value through the OCI. Unless the assets or the investment is retired or disposed of, unless it is sold. So a notional gain or a notional loss in the OCI in respect of revaluation of the asset, of the investment in the equity instrument, that notional gain and the notional loss which is captured in the OCI, not reclassified in the P&L account, that notional gain and notional losses in respect of the asset and the investment in the equity instrument will not be considered in the adjustment while determining the book profit. That is point number one. Now, what is that asset for which the notional gain or notional loss will not be considered? The assets are those which are referred in Ind AS 16 and Ind AS 38. We don't have to worry about it. And investment, students, this investment, be careful about it. Two investments. One is investment in the equity instrument, and the second is investment in the subsidiary, JV and the associate. So any investment which you have made in the subsidiary, that investment, whatever is the notional gain or notional loss, will not be considered in determining the book profit. Demerger, students, keep this point in mind, students. Demerger, at the time of demerger, again, if there is any, see, demerger is a merger, there is no actual sale, and therefore whatever is the notional gain or notional loss which has arisen at the time of demerger, that notional gain or notional loss also will not be a part of your book profit. Is that clear to all of you, students? Fine. And be careful on this one. Point number 4. Now just directly from point number 4 I am taking first. What is point number 4? Foreign operations. Foreign operations means a company may have got a branch outside India. So from that branch, 31st March, if any revaluation has happened, then no notional gain or notional loss from that branch I am going to consider. No notional gain or notional loss I am going to consider from that foreign branch, unless what? Unless that branch is sold. So even that is clear. So notional gain and notional loss in respect of asset, in respect of investment in equity security, in respect of investment in equity instrument, in respect of investment in subsidiaries, in respect of demerger, and in respect of the foreign branch. Whatever is the notional gain and notional loss that will arise, that will not be a part of your book profit. Now, the first year, whenever a non-Ind AS company gets converted into an Ind AS company, there will be a huge valuation exercise that will be done, because from the historical cost, now you are determining the fair value. So therefore there will be a huge change that will happen. From historical, it will go to the fair value. So therefore there will be a huge notional gain and notional loss in the year of convergence. That is known as the transition amount. That notional gain or notional loss is known as transition amount. Now on that transition amount also we have to exclude some items. Which items? The same items that we have referred earlier. Which items? The 5 items. Which are the 5 items, friends? Again, repeat with me. Which are the 5 items? The revaluation of the assets, the investment in the equity instrument, the investment in the subsidiaries, the demerger is not applicable here. The next one is a foreign branch, foreign operations. So through the foreign operation, whatever is the revaluation, so all these items, whatever is the notional value, notional gain or notional loss, that will not be a part of the transition amount. And now whatever is the final transition amount that you have got, you will take 1/5 only, which will be either added if the credit side is higher, or it will be reduced if the debit side is higher. It will be added if the credit side is higher, or it will be reduced if the debit side is higher, as the case may be. But again, I am repeating, the transition amount which is the convergence that has happened and the valuation that has moved from historical cost to fair value, in that transition amount, these 4 items will not be considered at all. Which 4 items? I already have discussed this point with all of you. Now, apart from that, students, one more point in before I head to that question. So I am doing set of adjustment and one question. Set of adjustment and one question, so that at least that has been taken care of and there is no such desperation. Brought forward loss and the unabsorbed depreciation as per the books. Only one of the two will be allowed as adjustment in computing the book profit. Brought forward loss or unabsorbed depreciation as per the books. Books, not as per the Income Tax Act. Only one of the two will be considered. While which is that? What is that will be considered? Whichever is lower. Only that will be considered for the purpose of adjustment in determining the book profit. Okay. However, there is an exception. Both of which will be considered in the following case. Which case? Insolvency case, when the application for the bankruptcy has been made. So that is one of the case which has been there. And second one, students, is where through the order of the court, the central government has suspended the board of directors and has resumed it. Through that central government has suspended the board and has resumed it. Generally, they will target the insolvency, but still you should just know that, okay, if the board has been suspended and the central government has taken across, in that case also, both the brought forward loss as well as the UAD will be adjusted. On that note, friends, I am taking across directly one question and I will compare this question with one more question, so that both the comparison is known to all of you quickly, and let's try to finish it off in the next 5 minutes or so. ABC Limited, an Indian company engaged in pharmaceutical formulation in Tamil Nadu, started adoption of Ind AS with effect from 1st April 2019. So previous year 22-23, obviously that 1/5 of the transition amount will have its effect in computing the book profit. The following particulars are furnished for the year ended 31st March 2023. What is that, friends? The book profit after the adjustment of all items specified in 115 JB2. Now 115 JB2 is nothing but all the adjustment other than Ind AS adjustment. Please be careful. 115 JB2 is all the adjustment other than Ind AS adjustment. For Ind AS adjustment, we have to refer to A. That is what Ind AS adjustment is all about. So already they have given you the book profit up to the point of before Ind AS adjustment. They already have given you the book profit. How much is the book profit? 52.26 lakhs, except the adjustment of the brought forward loss. So that has not been adjusted for the year ended 31st March 2026. Now see point number 2. The brought forward loss in this case, as per the books, are as under. How much is the brought forward loss, students? Just it has moved here. So for this here, in this case, it is this amount, and for the other one, students, it is this one. So over here for 2019-2020, it is the business loss is 4.6 and depreciation is 4.90. 2020-2021, the business loss is 1.75 and depreciation is 2.20. Point number 3, the business loss of 4.6 lakhs and 1.75 lakhs, which is for the 2 years 1920 and 2021. So business loss of 4.6 lakhs and 1.75 have been deducted. Students, this is a statement, have been deducted while computing the book profit for the assessment year 2021, means the next year and next to next year. So therefore, in the subsequent year, why business loss only has been deducted? Why business loss only has been deducted? Because it is lowest than as compared to depreciation. If you see, it is lower than the depreciation. So only the lowest would be allowed as deduction. So that is why it has been reduced. That is point number 3. So it has been reduced, has been given to you. Okay. Now just students, a very quick departure, and I'm just moving to question number 2 to give you this feel of what is this there in the question number 2. What is there, students, in question number 2, students? If you see this one very carefully, students, if you see over here very carefully, this question number 4, this is again the Ind AS question. See point number 2. Point number 2, brought for loss and depreciation. Brought for loss and depreciation. Business loss 3 crores, depreciation 1 crore for 17-18, and for 18-19 5 crores and 2 crores. Now next to that table, that statement is not given to you. Next to that table, that statement is not given to you. What is the statement? That business loss of this year has been reduced. What does it imply? It implies is that, what does it imply, students? It implies is that these are the outstanding business loss or the outstanding depreciation for these 2 years which are yet to be reduced. These are the outstanding business loss and the outstanding depreciation for these 2 years which are yet to be reduced. This is how it has to be interpreted. So in the previous question, they have again given you data of 2 years, but below that what they have told you, that the business loss of these 2 years has been reduced from the subsequent year profits. So then what is left after that? Only depreciation is left in the first question. Whereas over here in this question, they are only giving you the table of these 2 years, but they have not told you below the table that whether the business loss or depreciation, whichever is lower, has been reduced in the subsequent profit. What does it imply? It implies in this question that the business loss in this case and the depreciation balance is what is remaining unabsorbed. This is the remaining balance of business loss and the remaining balance of depreciation which are yet to be adjusted. These are the remaining balance as on date. And this is how it has to be interpreted. So here all the 4 figures are pending for adjustment, whereas in the previous question business loss is already adjusted and that has become 0 now. Business loss has already been adjusted and that has become 0 now. So what is left, students, in this case? What is left, students, in this case is the depreciation part. What is left in this case is only the depreciation part. This is the way you have to read down this question. Now if you see point number 4, the particulars of other OCI for the year ended 31st March 2023 is what, students? If you see over here, now please have a look. What is this OCI? That may be reclassified to the profit and loss account. What did I told you? If it is reclassified to the profit and loss account, we will not even see this. Ignore it and move on to the next one. Other OCI, that will not be reclassified to the debit of profit and loss account. This is what we need to focus on. And what we have got at, students, from this there is 14.1 debit and 22.4 credit. Now technically speaking, what we are supposed to do? We are supposed to reduce it. Technically speaking, what we are supposed to do? We are supposed to reduce it. But in this value, we are supposed to ignore something. And what is that ignore? I told you: asset, equity instrument, investment in subsidiary, demerger, then the foreign operations. That has to be ignored. Let's have a look over here. So see, 10 is what? Equity instrument. I'm just directly considering that. And revaluation or surplus of asset, students, 7.5. Rest of it I'm not reading because they are not in that exclusion category. So just 10 I'm reading and 7.5. So 22.4 minus 7.5 is what will be added. 22.4 minus 7.5 is what will be added in the book profit computed above, and 14.1 minus 10 is what will be reduced in computing the book profit above. So that is what it would be, students, so far as this is concerned. Now if you see over here in point number 5, the transition amount as on the convergence date stood at 52.5 lakhs credit balance, including the capital reserve of rupees 8 lakhs. And just hold on, students. This point I missed upon. Just a second. On the transition amount. This point. Transition amount means, let's read this one. Transition amount means what? It means the aggregate of the amount adjusted in the other equity, excluding capital reserve and security premium reserves. So not only that 5 items has to be excluded. What else has to be excluded in the transition amount? Students, what else has to be excluded in the transition amount? Capital reserve and security premium reserve. These 2 items has to be reduced further, in determining the transition amount. These two items has to be reduced further in determining what the transition amount, and that exactly is the point. So therefore, if you now see over here, students, in this case, if you all see, students, now here in this particular case, so in this situation, 52.5 lakhs is a transition amount credit balance, which includes the capital reserve, which we have to exclude it, because capital reserve and security premium reserve, both of them has to be excluded. So from 52.5, I'll reduce 8 lakhs, an adjustment of 4.5 lakhs relating to transition difference of the foreign operation. So foreign operation also we have to reduce. So therefore total reduction will be 12.5. So 52.5 minus 12.5, which is 40. 40 divided by 5, it is 8, and therefore it is 8 which will be added. Why added? Because it's a credit balance. 8 which will be added, which will be credit balance. Now see point number 6, the national company. So IBA, this is the insolvency case. So the two items of the depreciation which are yet to be adjusted, two item of depreciation which is yet to be adjusted, that will be adjusted further in this case. So two item of depreciation which are yet to be adjusted, that will be adjusted further in this case. I hope that all of you are clear with this one. MAT rate is 5%, and just check the surcharge. Surcharge is the same, 1 crore above, 10 crores above, 7%, 12%. As far as 7%, 12% as far as domestic company is concerned, and if it is a foreign company, then the surcharge rate, as you all are aware, is 2% and 5% if the total income, if the book profit is exceeding 1 crore or 10 crore as the case may be. If the book profit is exceeding 1 crore or 10 crore as the case may be. I hope that all of you are clear with this one, and therefore this is what it is. Sometimes they will also tell you calculate the MAT credit. MAT credit, I think all of you are aware, if the tax on the total income is lower than the MAT, then the liability would be as per the MAT. If the tax on the total income, which is already given to you in the question, if it is lower than the MAT, then the MAT is the liability. But the excess liability that you have paid because of MAT, the excess liability which you have paid because of MAT, that excess amount will be allowed to be carried forward for 15 successive AYs. I hope that all of you are clear with this one now in this particular context. So this has been done in this regard, and that question, students, in that question which I was telling you, question number 4, which I have dealt with all of you in this context, question number 4, students, which I have dealt with all of you in this regard. Can you see over here? Here also, students, in that question number 4, they have gone for the insolvency and bankruptcy code. But the fact is, what I told you in question number 4, the business loss and the depreciation, this is the balance amount which is yet to be adjusted because they have not given that statement, and hence if the SSE has filed for the bankruptcy code, then what happens? The entire business loss and the entire depreciation, students, that will be reduced. The entire business loss and the entire depreciation, students, that will be reduced in this particular case. Is that point clear to all of you, students? And that is how the things has to be looked upon. Now with that, students, I'm going to very quickly run through one particular, the adjustment part, and immediately after this, students, you will refer one question. Immediately after this, students, you will refer one question in this context of these common adjustments. Now what are the common adjustments, students, in this case? If I take you through the common adjustment, students, let's have a look. Now, students, there are 3 adjustments in the MAT. 3 adjustments are there in the MAT. One is the index adjustment, which we have just discussed. Second is independent add and independent less. I'll do first that. Independent add and independent less. Independent add and independent less, students, has got these items. Independent add and independent less has got these items. Which are those items? Provision for unascertained liabilities. So any provision for unascertained liability, that needs to be added back. Provision for losses of the subsidiary will be added back. Income tax paid or payable. Now be careful over here. Income tax paid and payable, what does it include in this case? Income tax includes what? Dividend distribution tax. It is not there. So it includes what? Interest under this act. Be careful. Surcharge and the cess. Interest under the act. Students, just tell me one thing in this case. If supposingly there is a question which is very popular. I am a company. I was obligated to deduct TDS. I was a company and I was obligated to deduct the TDS. But I have not deducted the TDS. then what happens, students? Expenditure disallowance, that is fine. But apart from that, if supposedly if I have deposited the TDS to the government late, if I have deposited a TDS, students, late, in that situation the interest will be charged. In that case, students, the interest will be charged. Now whether that interest which has been charged to me on late deposit of TDS, will that interest, will it be allowed as deduction to me in the computation of the total income as per the normal provision? Whether that interest, will that be allowed to me in computation of my total income as per the normal provision? To that the answer is yes, it will be allowed to me in computation of total income as per the normal provision. Why? Because this is not my income tax, huh? This is the TDS, so it's not my income tax. If it is an interest on income tax like 224A, B and C, then that is not allowed. But this is not about interest on income tax. This is about what? Interest which is paid on late deposit of TDS, and therefore on that interest there is no question of any TDS which will be there. There is no question, students, of what? On that interest, students, there is no disallowance that will be there, because this is about for late deposit of TDS. So the interest which has been charged, that interest amount, student, will that be allowed to you as a deduction? To that the answer is yes, it will be allowed as a deduction in computing the total income under the normal provision. But the same interest on the late deposit of TDS, will that be allowed to me in computing the book profit? The same interest on TDS, will that be allowed to me in computing the book profit? Answer is no. And why is it so? Because interest under this act is what they have mentioned, and therefore interest on TDS is also an interest under the act, that will not be reduced in computing the book profit. I hope that all of you are clear with this one now. Dividend paid or proposed also has to be added back. Provision for diminution in the value of asset. The basic example that you will be getting would be, the basic example of provision for diminution in the value of asset is provision for bad and doubtful debts. A provision for bad and doubtful debts is nothing but the provision made for the diminution in the value of the asset, and therefore such provision, will that be added in computing the book profit? Answer is yes. Now if you see the independent deletion, only one case, Sikh company, students, over here, Sikh company, students, as you all are aware, the Sikh company, in this case their profit is not subject to MAT. Sikh company, their profit is not subject to MAT. Up till what point of time a company can be considered to be a Sikh company? So up to what point of time a company can be considered to be a Sikh company? Till the time their net worth is not equal to the accumulated losses. Till the time their net worth is not equal to accumulated losses. So if the accumulated losses, students, the accumulated losses, if it is greater than the net worth of the company, then in that case that company will be referred to be a Sikh company. If the accumulated losses is greater than the net worth of the company, then that company will be considered as what? As a Sikh company. Okay, so if it is net worth is equal to the accumulated losses, it is not a Sikh company, and that is what it is in this regard. So that covers up this particular point, students, of the independent add and less which you have considered. Now the third and the last adjustment, students, in this regard is what? The third and the last adjustment, students, in this regard is in respect of the interlinked add and less. The interlinked add and less. Now what are this interlinked add and less? Very quickly, students, we will run through this one. In this context, very quickly we will run through this particular part. In the case of interlinked, students, any amount if debited in the profit and loss account in the name of reserves, by whatever name called, will be added to the book profit. So once you create a reserves, students, reserves are, you will debit to the profit and loss account and you take up to the liability. You will debit to the profit and loss account and you will take up to the liability. So debit to the profit and loss account, so you will add it back in computing the book profit. Okay, now subsequently when that reserve will be written off, in the profit and loss account credit side, because it is in the liability, na? If it is written off in the profit and loss account credit side, then it will be double taxation, because already when the reserves was created, it was being added back. So now if you are writing off the reserves and it is put up in the profit and loss account credit side, then it will result into double taxation. So what you will do, you will then reduce what? Reduce the amount of reserves just to avoid the double taxation. Because At the time when the reserves was created, that amount was added back. So now subsequently when the reserves are written off from the liability side and put up in the P&L credit side, then that amount, in order to avoid double taxation, will be removed in computing the book profit. Is that clear to all of you? But in one of the question, they have given to you that if the question says to you that in the year in which the reserves was created, in that very year, there is no add back that has happened. In that very year, there is no add back that has happened. So if no add back has happened, and subsequently if the reserves has been written off, so if no add back has happened, means on the reduced book profit I have paid the MAT. On the reduced book profit, because no addition has happened, on the reduced profit I have paid the MAT. So if subsequently if the reserves are written off, will that increase? Will you remove the reserves in the book profit computation? Will you remove the reserves in the book profit computation? No. Why? There is no double taxation. Point number 2. Students, just keep this point in your memory. If there is any revaluation made on the asset, then please remember this, then the depreciation to the extent of revaluation which is debited in the profit and loss account. Repeat with me. Depreciation to the extent of revaluation which has been debited to the profit and loss account, that much portion of the depreciation will be added back. That much portion of the depreciation, students, that will be added back. So what is to be added back? Only the depreciation on the revaluation portion has to be added back. That is what they are saying. So DTA and DTL or income tax, if found in the P&L account, DTA, DTL or income tax if found in the P&L account, kindly remove in calculating the book profit. The next point number 4, friends, you will ignore it. Point number 4 and 5, you will ignore it completely in this case. 4 and 5, ignore it. And coming to the 6th one over here, students, is about any exempt income and any corresponding expenditure in respect of the exempt income. Any exempt income or any corresponding expenditure in respect of exempt income, even that will not be a part of the book profit. Even that will not be a part of what? The book profit. Is that point clear to all of you? So any exempt income or any corresponding expenditure in respect of the exempt income also will not be a part of the book profit. And that is the point. Now, therefore, if a company is a partner in a partnership firm, then the company will receive the share of profit in the partnership firm. If the company is receiving the share of profit in the partnership firm, then that share of profit will not be a part of the book profit. Then that share of profit will not be a part of the book profit. Is that clear to all of you? And that is what this point number 6 is all about. Fine. But if the company is a member of the AOP, if the company is a member of AOP or BOI, then they will get what, students? They will be getting the share of the profit from the AOP and BOI is not included in the total income, but not under section 10. It is not included in the total income, but not under section 10, but under section 86. So if a company is a member of an AOP and the company is receiving the share of profit from the AOP, so that share of profit from the AOP will also be not included in the book profit. That share of the profit will also not be included in the book profit. Now, students, keep in mind this point number 8 and point number 9. Now, always consider this. If you remember, students, in the first class of LDR, we have discussed the taxation of royalty, and at that time I told you a resident who has earned patent royalty, a patent royalty which satisfies the condition of 115 BBF, that patent royalty is going to be charged at a concessional rate of 10%. That patent royalty is going to be charged at the concessional rate of 10%. So students, what you have to do is this. Be careful now. What you students have to do is this one in this context is this one. That patent royalty, students, which has been there. That patent royalty, students, which has been there. Only MAT rate is 15%. Okay. For a resident domestic company, that patent royalty which goes under 115 BBF, that patent royalty also will not form part of the book profit. Will not form part of book profit, students. In this case, is that clear to all of you? Because why is it so? in this case, because there is a special concession that has been given to you. That is a special concession that has been given. Rahul, same to you. So that is what has been given to you, students, in this case. So that patent royalty also will not be a part of the book profit. Is that point clear to all of you, students? That is how it has to be considered. But if it is a foreign company, be careful. If it is a foreign company, then any profit or any income of the foreign company which is charged to tax under the normal provision, at a rate, which rate? Rate which is less than 10%, sorry, less than 15%. As far as the foreign company is concerned, if they have got any income which is charged to tax at a rate which is less than 15% under the normal provision, all that income will not be a part of the total income. Sorry, will not be a part of the book profit. So just imagine this. Think of it like this. If I'm a domestic company, I have got a long-term capital gains of 112A. And if there is a foreign company, and the foreign company also has got a long-term capital gains of 112A. So what happens for a domestic company? That 112A long-term capital gains in the normal provision is taxed at the rate of 10%. But will it be excluded in the book profit computation for a domestic company? No. Why? Because only one income is to be excluded, which is taxed at the rate of 10%, which is that? Which is 115 BVF. But what about the foreign company? If they have got 112A long-term capital gains, because it is taxed at 10%, for a foreign company less than 15%, therefore all the income will be excluded in computing the book profit. All the income will be excluded in computing the book profit. I hope that all of you are clear with this one. What about royalty and FTS income? Under 115A, 10% is the rate. For a foreign company who has earned royalty and FTS income, charge under 115A, that particular royalty and the FTS income also will not be a part of your total income. That also will not be a part of what, friends? Your total income. Is that point clear to all of you? And that exactly is the point that has to be considered over here in this case. So students, this is what it is. Now my suggestion to all of you, this is what this India's adjustments are all about. Now what you will be doing immediately, students, would be one, that trust taxation question you have to solve quickly, students. The trust taxation question you will have to solve quickly. And after solving the trust taxation question, one comprehensive question, whichever question that you take up, don't take very big question, normal questions you take it. And after taking across one math question, India's 2 questions I have done it. In this case, you can take one math question, and if I have to say question number 5, Mahadev and Sons Limited will be sufficient for all of you. Question number 5, Mahadev and Sons, this is a good question. So take that and wrap it up, students, quickly. So that is it, students. Now students, what I will do in this case, tomorrow I'm going to meet you at 8 o'clock in this scenario for TDS and TCS, first in the morning. Okay. And thereafter in this TDS and TCS, I'll also deal with the assessment procedure plus the search and survey. Fine. And immediately after this, students, now PGBP, I've told you already, business deduction, there are only few sections which I have already carved out. I'm not taking the full topic on this one. Capital gains also, I told only one particular area. And the theory of international taxation. Appeal chapter is important. Chetan, any case appeals, what you should be dealing with it. In the case of an appeal, suppose you don't think of even quitting this topic per se. My suggestion to you would be, in this case, appeals, revision, appeal, why you have to leave it, students? You have got ample time. Revision and appeals, I told you to deal with it. Revisions, appeals, rectification, recovery. If you have done it, there is no harm in not doing it again. If you have not done it, then that's a different question altogether. So in that appeal topic, at least in this situation, is a theory topic primarily. So rectification, recovery, DRP, these topics has to be dealt with it. Appeal, please do it if you have done it. Don't leave the topic per se as it in this context. But nevertheless, what is important is that particular, the stay, focus on the stay part categorically. Other than that, stay, the limit Chetan, the limit part, the government, they have limited 50 lakhs, 1 crore, that you all are aware. If they have to go to ITAT, this is the limit of filing an appeal. If they will have to go to High Court, then this is the limit of filing an appeal in Supreme Court. That limit part you just keep in mind. So that is what I'll suggest to all of you, and that is what it is. So students, this is primarily what it will be dealt with it in this context tomorrow. So now students, primarily all the practical area I'm dealing with it. In this case, TDS and TCS also I'll do a decent job. In this case, tomorrow 8 AM, and we'll wrap it up this particular part with the assessment procedures. Assessment procedure which I'm dealing with it would be the updated return, survey, search, and finally with 147. Fine students, see you then tomorrow at 8 o'clock with TDS and TCS. Get started students, immediately first finish off those topics and then move on further. PGBP, I've already told you five sections, 35, 33 AB, 36, 17A, and those particular areas which I've told you. That is what I'm going to target so far as that particular part is concerned. Fine students, so that is precisely what I'll be targeting it. And in that, if that be the case, I'll also deal with the ICDS part. In that situation, students, I will deal with the ICDS part. So PGBP limited section which I've given to you in the previous LDR, plus the ICDS, quickly I'll just run through those ICDS which has got the impact on the competition. And thereafter the CG part 1 section, students have told me, and the theory of NR. This theory of NR, I'll keep it short and precise in 30-35 minutes. We'll wrap it up, those particular theoretical part, and that should be all. Okay, get started students with this particular part. Clubbing of income, please do the question and answer. It's an important section for this attempt. Clubbing of income, don't leave clubbing of income. It's an important chapter. Fine students, see you then tomorrow at 8 o'clock in the morning. I'll share the link. Share the old video. Old video already is it's there in my Telegram channel. Prem, see the old videos in my Telegram channel, link of which has been given in the description box. In case of foreign company, then AOP point not considered, because foreign company is not a part of AOP. Means any company receiving the share from the AOP, the share of AOP will not be a part of the book profit. As simple as that. Happy Diwali to all of you students. Okay, and in the morning I'll take a stock of the situation, and from all of you. Morning 8 o'clock I'll take a stock of the situation from all of you, and then I'll decide how we have to go about it in terms of what is there in the part of it. So students, stretch it up further in this case. Happy Diwali to all of you students. Yes, ignore that particular point, Prem. Frankly speaking, I'm not understanding your query. You can ignore that particular point. It is a very typical query you are asking at a very typical moment. So I'm not in a position to understand your query. उसको आप छोड़ दो. उसको अभी आप फिलहाल इतना वो क्या वो query का context है वो उतना deep में नहीं आएगा. उसको अभी फिलहाल ignore ही कर लेना. Happy Diwali to all of you students. Try to stretch as much as possible tonight. Tomorrow morning we'll meet up for TDS and TCS quickly, and then assessment procedure for that particular part. See you then friends. Take care all of you. Happy Diwali.